Hello there, this is Trudy, and we have Money Matters Mondays. I know that you thought that we had stopped, but no, we didn't. We had to take a break. Was having some technical difficulties, but guess what? We're back, and we have a more exciting information to share with you. I want to make sure that we kind of go back and revisit and recap a little bit on what we've covered previously. As we've gone through in the previous months, what we talked about were budgeting, that we were talking about knowing what the 50/30/20 rule was, how to handle our paychecks, to understand what's on our paychecks and how is our money allocated, where is it going to. Um, we also talked about modifying our behaviors in spending, where we gave the example that instead of having coffee at Starbucks for an entire week, we save and maybe go buy coffee and buy the things that we need to that you drink every day and start making your own drinks. That we look at the savings that we have there, because on average, if you figure you're paying $5 for 5 days a week, $25, and we 4 weeks in a month, that's $100 that you're actually spending on a drink, when you can actually probably get that for half of the price and actually save that $50. Not that you can go out and spend it, but you're going to save it. Then we started to talk about using different types of saving accounts that would be available for us, so that we could take those earned savings and actually start to deposit them into something that's going to actually grow for us. So we talked about that. We talked about credit, what credit was, who were the holders of our credit, what were our rights as credit users, and to understand the whole concept of credit, what credit was instituted for. It's not instituted for long-term things, but that's where people get us locked into it, because we get in these long-term things instead of making sure that we can afford what we buy and use the credit system to actually boost us, so that when we're in the marketplace, we have favorable looks, that we can stand in that 700 plus group and make sure that we're getting the best rates. Because what they depend on is that you will get these things and you get excited and you mess up, and you're going to pay these exorbitant amounts, and you're going to keep paying them and making the minimum payment and continue to make people rich. But we were talking about taking hold and taking charge of your own profiles and understanding how to use credit to your benefit. And then the next thing that we came up with was we were supposed to do in the month of April, where we were going to concentrate on some things in regards to mortgages, because one of the things that I was wanting to make sure that everyone had the opportunity to is that when deals come along, that you have all of your information in order and you're actually able to take advantage of these things. So we talked about all these things, and this was all the ingredients. It was like the cake that we're making, all the ingredients that are necessary to make sure that we have a complete and beautiful cake when we're done with all these things. So the thing that we're going to talk about for April was pre-quals versus pre-approvals. Now, we oftentimes get pre-qualified offers throughout the mail. You can get them from car dealers, which are probably most prevalent. And I think Capital One is probably the most popular one that they have out there. But you get that, you get them for home improvement. You sometimes get them for high ticket items and things like that, where people are enticing you to come in and spend this money. So what happens is that when you get a pre-qual, a pre-qual only means that we have gone through certain criteria, meaning they've looked at you, you have some source of income, they can tell that you don't have major red flags like bankruptcies and things like that, so that you meet certain check boxes. And they're saying, well, they meet 6 check boxes, so we're going to send this to them in hopes that they can reel you in with a credit offer. This is what a pre-qual does. Pre-qual does not mean that you are already approved for anything, because as I always tell you, go to the fine print. And when you look at the fine print, you will see that there are a lot of requirements that go along with that. That they want you to have a certain credit score before you did it, or that you had to be at a certain income level. But we never look at that. All we look at, oh, pre-qual, I want to go try this. And most of the time we end up doing more damage to ourselves because we get into these things that are unfavorable rates for us. So you end up paying for more of what they call the starter cards, and you end up paying these absorbent amounts, 29%, 30% on interest rate, and they're not giving you any more than about $500. So, and then we talked about, remember, with the credit and what your ratios have to be and how much your usage or utilization has to be, that if you get a $500 card, you can only spend roughly $50 in order to stay within the usage ratios. But normally when we get a card, it's that they either meet us at the register saying, oh, well, you could put this and open a brand new card and put your purchase on the card. But what you don't realize is that when you do that, you're actually causing your credit utilization to go sky high because you've gone way beyond what the limits are. Unless you're wise enough to start the card, the money that you were going to pay for the items, you come and before the billing cycle starts, you make a payment on that account. Therefore, even Steven, you just got some more credit to expand, you paid off a bill, and that all it does is actually help your credit scoring. So that's wisely how you would use credit, that you would only allow it to stay for a certain time period, you pay it off, and in essence what happens is that the creditor sees how you're paying and wants to give you more and more and more and more credit. Therefore, when you do that, you get to spend more than $50 because your credit lines are gone up. If it's $5,000, then guess what? You can spend $500. But this is how it kind of works. So you know these things, and this is why they send you these things. Now, when we talk about a pre-approval, pre-approvals are those things where they come in and they ask additional questions of you. They want to know how much money do you actually make. They want to know how long you've been employed. They want to take what they call a hard pull of your credit. With a pre-qual, they do what's called a soft pull. It doesn't go against your credit rating or stay on your report. But when you do a pre-approval, they call it a hard pull on your credit, and it's actually an inquiry that remains on your credit. That's why we always warn against, don't just go out shopping for a whole bunch of things. Do your due diligence. Read what you're getting into before you just randomly just go out there and apply, hoping that someone will get you something. Because when you have all of those inquiries on your credit report, they also go against your FICO score. So you have to be very careful with these things and use credit very wisely. So when you're actually applying for a pre-approval, as I stated, they ask for employment. They ask for your wage earnings. They want to know where do you work? How, are you consistent in your work history? And once you do that, depending on what you're applying a pre-approval for, the documentation may get a little more intense. So if it's for, say for instance, you get pre-approved for a car loan. Let's say you go to a credit union or to a bank. They're going to ask for certain documents. They're going to want to see your paycheck stub. You can't just write things on it and not bring proof of it. They're going to ask for different things like that. They're going to ask for your bank statements oftentimes to see that how you pay your bills. People, they really kind of get all into your business, which they have to because they want to see how credit worthy you are. If it's a mortgage that you're going to do, that you're going to go in and you're going to bring W-2s, you're going to bring your tax returns. W-2s would be your statements that you get at the end of the year. They might ask for current paycheck stubs, especially if you're a person that has sporadic income or you work a lot of overtime and things like that, and your income seems to fluctuate a little bit, so that they can get to a median income for you, so they can figure that consistently we can at least expect this amount of money from you. So they'll ask to bring those things in like that. And your bank statements, like I said, they'll audit your bank statements and different things like that. And they will pull your credit. And once they pull your credit to see exactly where you are and whatever you may be applying for, then at that particular point, they are going to actually go in to see how your loan ratios actually work. So there are certain guidelines that the Federal Housing Department has, the government has for ratios, and they might be 36 over 38 or 36 over 43. It just depends on what particular programs that you're applying for, whether it's a conventional, meaning that you're going to a bank for a standardized type loan, or if you're going through a broker who will shop whomever, whether it's institutions or private lenders that are actually lending, or if they're going to go through government particular loans or products that they have. So the ratios vary, but this is why they actually ask for all of this concrete information so that they can make sure that the amount of money that you're going to be obligated for divided into the money that you make every month will give you a ratio. That is basically what it is. What you earn versus what you're going to owe divided into each other gives a ratio. Then on the bottom half, you have a top ratio and a bottom ratio. And then on your bottom ratio, it will be what you're going to owe plus all of the bills that you owe. So now you're adding on some more heavy weight to these things. So, and then they're going to take that and divide it into how much money you make, and then you get your bottom ratio. So that's basically what helps them figure out what's going on with you. The better your credit score, the more favorable you are in getting what they call prime rates. So you don't pay the higher end rates or the more risky pricing, but you pay more of what a prime rate is. Basically, the bank is not making a whole lot of money off of you, in short. That's it. And a lot of times we don't get to see those things happening because of the fact that we don't have our business in order. And this has always been my heart's desire of why to do this. As I explained before, I've been in the mortgage industry for quite a long time and on different sides of it. And I spend the bulk of my time in the processing management of that. So everything, every piece of paper that came through, every funding check that went out the door, that passed through my hands basically. So this is what happens with a pre-approval. So once we get all these documents and then when they decide what you're doing and you get pre-approved for a certain amount. Now, the next step with that, once you're pre-approved, it is a wonderful thing because it actually gives you a realistic perspective of what you're doing. Because some of the downfalls that happens that when we start to shop for things, we have no idea what we can afford. You spend hours in car dealerships listening to somebody with a sing-song back and forth, back and forth, back and forth. But when you come in with a pre-approval, you already know how much you actually can afford. And they know what they have to work with at that point. The same thing with shopping for a home. If you have a realtor and you come in with a pre-approved letter from a banking institution that will guarantee a certain amount of money that they're willing to give you, then it makes the job of the realtor, it makes you a lot happier in the process, and it makes the lender happy. Because at that point, all you're literally waiting on is to make sure that you found a property that fits the criteria of the amount that you're approved for, and to make sure that there are no health and safety issues. And the bank is basically saying, we got as far as your payback information, because that's what they're concerned about, how you're going to pay us our money back. And we can see that that's all intact. All we're waiting for is the property. And then when you have that, that gives your realtor such a boost because they will work even harder for you because it's like having a bird in the hand. They know they don't have to go back and wish and think Are they going to get approved or anything like that? You have everything in hand and you're ready, set, go. This is how opportunities are taken, because everybody has their information, um, their financial prowess is intact. They already have done the work, what they need to do, so that when the opportunities actually come available, they're able to jump in on these deals. And that's the same thing that I want for you. So we will continue with this vein of information that I'll drop in every now and then and give you some tidbits about some things that are going on that are affecting us economically, so that we all are aware and we can all buckle down. When sometimes when we have the fat of the land, we can't go over the board, because we have to remember there will be lean times that we have to fall back on the things and the practices and that we've actually put in place in order to help us through those lean times. So we want to make sure that we're not spending any more money than what we have to, and that we are our own best lenders. We are. Remember this: they can't do business without you, but they will do business to you if you don't know what you're doing. So make sure that you come back again. We're going to try to continue on our Mondays, so that we can actually have more dialogue with each other, and other topics that you might want to talk about that are prevalent today. But that's it for Money Matters Mondays. Thanks for joining me, for your time. We'll talk soon again as we go into the month of May about some critical things that are coming up that might affect all of us, or might be of interest to all of us, okay? So have a good evening, and I will talk to you soon. Bye-bye.